India's bond yields have been rising. What are the reasons behind this?
Rise in US yields. Our inflation numbers for last 2 months has been higher than 5%. And also the fact that our currency has depreciated and we have lost close to $50 billion in reserves.
Your take on the liquidity in the banking system?
See, the total core liquidity in the banking system was close to 4,80,000 crore in mid-September or towards end of September. And as we speak today, the core liquidity is down to 1,80,000 crore. So in a span of 2 months, we have seen close to 3 lakh crore liquidity loss from the bank, from the overall system.
Lots has transpired in the last couple of months. In September, we saw the US Fed's substantial 50 bips rate cut. In October, the RBI changed its stance to neutral while maintaining a repo rate of 6.5%. November was majorly dominated by the US elections. But here we are today to discuss what lies ahead in the month of December for the debt markets. For that, we have Mr. Deepak Agarwal with us. He is the CIO Debt, Kotak Mahindra Asset Management Company. Thank you so much, sir, for joining us today. So my first question is, India's bond yields have been rising. What are the reasons behind this?
Hello, hi Dheeraj. See, if you look from mid-September when Fed had cut rates for the first time, the US long-term rates or the US 10-year bond was close to 360 and now US 10-year bond is close to 425, 430. So US long-term bond yields have gone up by 60 basis points from, let's say, mid-September till mid-November. This was largely on two counts. One, the data coming out of US was strong, and second, market was also discounting the Trump government coming back to power. So these two factors led to the spike in US yields, and surprisingly, we also had one more 25 basis point rate cut this month from Fed. So broadly, let's say, rise in US yields, our inflation numbers for last 2 months has been higher than 5%. And also the fact that our currency has depreciated and we have lost close to $50 billion in reserves. All these three factors have led to rise in our yields. But if you look as compared to, let's say, US, where we have seen close to 60 basis point rise in yields, our rise in yield is relatively muted. From mid-September, we were close to 671 on 10-year bond, and currently we are around 682, 683. So our rise in yield has been relatively very muted.
Now, India's inflation reading, particularly food, has been in the uptrend. What's your take on this, and what are its implications on the RBI policy?
See, obviously, RBI has a flexible inflation management target. So inflation does matter. And inflation for last 2 months has been higher than 5%. And in fact, for the month of October, it was even above 6%. This inflation has gone up for last 2 months, largely driven by tomato prices. And now when we are seeing tomato prices going down, we are seeing onion prices moving up. So this will result in inflation for the month of November and December also be somewhere closer to 5.5%. But if you look at core inflation, or if you look at inflation excluding veggies, it has been sub 4%. So finally, monetary policy can't control vegetable prices, and central banker to a large extent should also be driven by core inflation. And if you see various Finman sources or various government officials have been making a noise around it. Anyways, monetary policy is actually governed by, or should be decided based on forward-looking inflation. And inflation for FY26 is likely to be, or is projected to be, around 4%. And this year, slightly higher inflation will also result in lower inflation next year. So based on forward-looking inflation, if your real rates are close to 250 basis points, there is a case for RBI to, let's say, reduce policy rates. Again, we'll have the GDP numbers, which are also important for monetary policy decision making. We'll have the second quarter GDP numbers released, let's say, tomorrow. And the second quarter GDP number is expected to be lower than 6.5%. Market is expecting closer to 620, 630. And even for the second half, market expect the, let's say, GDP growth to remain muted, closer to, let's say, 670, 680. However, for now, RBI believes that growth in the second half is likely to be higher. Let's say, rupee has been depreciating. And therefore, we believe that RBI is likely to push the rate cuts in, let's say, in calendar year 2025.
But what's your take on the liquidity in the banking system?
See, the total core liquidity in the banking system And when we talk about core liquidity, it is the central government cash balances and the liquidity which the banks have. These two numbers put together was close to 4,80,000 crore in mid-September or towards end of September. And as we speak today, the core liquidity is down to 1,80,000 crore. So in a span of 2 months, we have seen close to 3 lakh crore liquidity loss from the bank, from the overall system. This is largely on account of two factors. One, due to festive season, we had seen increase in currency in circulation. And second, due to the reduction in forex reserves, RBI has also sold dollars and sucked out that liquidity. So these two factors have reduced the liquidity in the banking system. From here till March 2025, if the FII flows don't pick up, and due to increase in CIC, this core liquidity is expected to reduce further. And hence, because RBI has now changed its monetary policy stance to neutral, we believe that RBI will infuse liquidity into the system. The tools, whether it will be on a, let's say, a daily basis repo or a long-term repo, or let's say OMO purchases or CRR cut, what is the appropriate tool will be decided by RBI, but RBI is likely to infuse liquidity into the system.
And lastly, your wisdom or any advice for the debt fund holders?
So for last, I think 6 to 9 months, we have been asking investors to increase their duration of their debt portfolio investment. Our view continues to remain same. So in US also, we expect Fed to cut incremental 75 to 100 basis point from here till let's say June 2025. In India, for FY26, again, monetary policy should be forward-looking. So in FY26, we expect inflation to be closer to 4%. In FY26, we expect growth to be on an average closer to 6.5%. So given the growth inflation dynamics, we see scope for RBI to cut rates by 50 basis point, let's say, over the course from here till, let's say, June 2025.
Okay.
And next year, given the roadmap given by Government of India, we expect in February 25, when they present the budget for FY26, we expect the fiscal deficit to be closer to 4.5%. So all these factors are making a case for yields to trending lower, and therefore we continue to advise investors to increase duration of their portfolio. And investors with 12-month plus investment horizon can either select a medium-term fund or a dynamic fund or a long duration fund.
Thank you so much, Mr. Deepak, for all the insights and all the advices.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.